right, we are going to be talking about how to underwrite multifamily. One thing I'll tell you as a couple of caveats is everyone underwrites differently. So part of what I want to do is talk in broad strokes and more so the philosophy of underwriting and how to approach it. And then also we can get into any specific Q&As. There's a few folks in the room who have a lot of experience, so just to differ up some of the opinions, I may bounce it to someone, so don't be surprised, Jim, if I call on you, Ivan. But with that said, we're going to get into it, okay? Exactly. All right, so who am I? My name is John Casmon. I am the co-founder of Casmon Capital Group. Right now, we basically operate where we have two verticals. We own and operate our own properties, as well as partnering with other operators to bring capital to their deals, as well as investor relations, marketing, and other tools. We have around 700 units in our portfolio right now, valued somewhere around $70 million. I'm the host of the Target Market Insights podcast. You can find that anywhere you listen to podcasts. All right, got one fan back there. Appreciate it. There you are, two. Okay. Oh, it's good, good, good. And as you all know, I'm the co-creator of the Midwest Real Estate Networking Summit. The other thing is, I mentioned the auction. I am an executive board member for Surge for Water. It's an organization that is really important to me, primarily because, we talk a lot about how to build our real estate portfolios and how to build wealth. We don't necessarily talk about kind of the end game and the end goal. For me, one of those things is to dedicate more of my time for the things that are really important that aren't necessarily financial, and it's helping people just live their best lives. That's an organization that really looks at water as a tool to drive sustainable community growth and development, and it's something that, a friend of mine, she left her high-paying corporate job to do this, and it just really inspired something in me to let me know that as much as we're grinding and trying to find ways to build wealth and create wealth, there are things as far as an impact and a difference in this world that we can make that go beyond the financial commitment. So that's that. And then also I have a very extensive marketing background. For probably around 15 or 20 years, I've been on the advertising and marketing side, working for large corporations like General Motors, different brands from, S.C. Johnson and so many others that we've done campaigns for. So definitely understand how to bring different marketing aspects together. But we didn't come to talk about that. We came to talk about underwriting. All right, so for a quick overview of what we're going to get into, we're going to talk about the return metrics, a couple different strategies. The two primary ones are buy and hold and value add. We'll also talk about the business plan, income statements. I'll give a very loose example, and then we'll talk about risk mitigation. All right, first and foremost, when you're looking at multifamily, you have to really start with what returns you want. You have to figure out what a deal looks like before you can identify if it's a deal. And it's not based on someone else's projections or someone else's numbers. Don't just shoot for 10% return because you think 10% is what a deal looks like. You need to figure out what a good deal looks like for you. And on top of that, what are the other elements? What kind of work do you want to put into the deal? Do you want to do rehabs or do you not want to do any renovations? Do you want to be in an A-class neighborhood, a C-class neighborhood, and all those other factors? So you have to really start by focusing on what your return metrics are and the amount of work that you're looking to do. Now, the different metrics that we use are, cash on cash. You have your average annual returns. There's something called an IRR, or the internal rate of return. What that basically is a measure of the velocity of your investment. So let's say you invest $100,000 into a deal. You make a profit of $100,000 over 5 years. What the IRR does, well, first of all, the return on that is 100% overall and then 20% annually, right? So with that said, that's a 20% average annual return. What the IRR does is measure how quickly you get that $100,000 back. If you invest $100,000 and in 1 year you get $80,000 back, that's a much quicker return than if you only get the $20,000 at the end of the 5. So what it does is it measures how quickly you get your money back versus just a pure cash-on-cash return. The equity multiple, that is one of the numbers that I like to use because I think it's the simplest metric. You invest this, you get X back. So typically that's going to be anywhere between a 1.5 to 2.5, 3, kind of depends on the types of deals you're doing. But we look for a 2x multiple on most of our deals, somewhere in that range, 1.85, 1.9 up to 2.0. Okay. So buy and hold. We talked about the two main strategies being buy and hold as well as value adds. From a buy and hold standpoint, what you're looking to do there is buy a property and hold it. right? It's pretty straightforward, right? And you're buying it based on the cash flow. So when you're looking at that, you're going to look at what is the current cash flow is kicking off. Is it going to give you an 8% return, a 10% return, a 12% return? You're buying based on the cash flow, and you're evaluating the property based on the amount of returns that you're going to get. The acquisition there also doesn't focus on the exit, typically. When people buy and hold, most of them will tell you they plan to hold forever. So they don't factor in the sell period or how long it takes to make a certain return or anything like that, because they're just buying it to hold, right? So when I think about buy and hold, this strategy is really about buying for what the property is today. Now, when we look at a value-add opportunity, what we're trying to do is drive cash flow and force depreciation. So what can we do to this property to make it worth more in the future, right? So here we're looking at IRR as one of our key metrics that we use when we're buying a value-add property. It's the time value of money. The acquisition here is based not just on what it's doing today, but what can it be in the future. Think about buying a property to flip it, okay? If you go to North Center, maybe there's a house that's delivering a 5% return, but that land is very valuable, and if you can upgrade that property and make some improvements, it could be worth a heck of a lot more. So you're buying not based off of the numbers today, you're buying that for what the value could be when you're flipping it. Value add is a very similar approach. When you buy a property, you're buying it not just for the amount of money it's generating today, but what can it be worth in the future? What's the opportunity? And that's the equity, that's what the upside that you're going to take is implementing a plan that allows you to unlock that equity, right? So when you're buying this, you're also going to have a very defined hold period. So that can be anything from 1 year, 2 years, 10 years. Ivan, you're holding for what, 30, 40 years now? 45 years, okay. That's a pretty long hold period, right? But you have, 45, right? But he's putting long-term debt on there, though. So he's putting long-term loans on his deals. But what you're doing here is you're buying for what it could be. So when you look at deal, how many people are having a hard time finding deals in the market right now? All right? So one, it is hard. But one of the things, especially if you're looking at smaller assets, one of the reasons it's hard and you feel like people are overpaying, one, they are overpaying, but what they're doing is they're buying based on what it could be. Now, the challenge is that they may be overthinking or over-projecting of what it could be, but that's the reason people are paying different prices than what you are, okay? So when you think about it, we talked about metrics and all those things, but that's really not that important. The most important aspect of multifamily is your business plan. What are you going to do, okay? So when you think about the business plan, you have a property, you're looking at it, there are only a handful of things you can change. You can change the operations. What is the current owner doing? How are the current incomes coming in? What expenses do they have? You can start to make some adjustments there. You can reposition the property. And in that case, maybe it's a property that's currently multifamily, but it would be much better as student housing. Maybe it should be a short-term rental. So maybe you can reposition it. Maybe right now it attracts a certain demographic, and it could attract a different demographic. So you can reposition it there. You can renovate the property. That's interior renovations as well as exterior renovations. So injecting capital into the asset to make it a better property. You can look at the amenities and change them. Maybe it has a swimming pool that no one uses. You know, we had a property where we had 2 swimming pools. Well, guess what? People weren't using that second swimming pool, and it didn't matter that much on the brochure. So we kept 1 swimming pool, we filled in the other, and we made it a barbecue area, okay? So what amenities can you do and change? And then the number of units. You can obviously build more units, or maybe you have oversized units where you can split them up and turn them into something else. Maybe you have mini offices where you can convert an office into a unit. So you can look at changing the unit mix there. All right, so when you're looking at this, you know, part of what it is, too, is really diving deep into the income statements. So there are key items that you want to look at. First of all, who knows what a T12 is? Okay. So the T12 is, those are the actual numbers. That's the income statement that you're going to get from a seller. So when you go to buy a property, you're going to request the rent roll and the T12. When you get the T12, that's the trailing 12, so the trailing 12 months of operations. They're going to give you this document. It's going to list out all the money that they've made and all the expenses that they've paid over the last 12 months. Now, a lot of times when you first get a deal sent to you, you get it sent from a broker, and you're getting what we call the broker's memorandum, right, the offering memorandum. And in there, they have great numbers. They'll put in there what they think the property could be. They'll oversell on projections of what it could do, and we'll talk about that in a little bit here. But you'll have all their numbers in there. But the T12 will tell the real story. If you look in there, you will see what's happening. And you want to go through there, and you want to be a bit of a sleuth. You want to look for inconsistencies. You want to look at months where the numbers spike off the charts, months where they take a dip. What's happening? And ask those questions. Hey, your water bill was crazy high for, January. What happened? And they might say, oh, we had a water pipe burst, and, we got that fixed. Okay, now you know, okay, I got a water pipe burst. You got different issues you need to work at. Any question there? You get the best information you can. So let me get to that in a second. But part of what you do is you get as much information as you can. Can you get bank statements? Can you get rent rolls? Like, what information can you gather? And then you have to sometimes, make the best decisions based on the information you do have. Okay. But the other things you want to look at on this T12, you want to look at the physical versus economic occupancy. So a lot of times people will list how much, how many people on the rent roll. You'll see how many people live in the property, but it doesn't necessarily tell you how many people are actually paying rent. So people can live there and not pay rent. And if anybody's ever tried to evict in Chicago, you know how difficult it is to evict someone, right? So you need to understand not just the physical occupancy, but what is the economic occupancy. Now, economic captures not just the physical piece, but is there a loss to lease? Are there people who you would charge them more in rent, but because they've been living there for the last 2 years, you let them go $50 under market? Is there someone in there who you did a move-in special for them, so you allowed them to come in for $100 off that first month? This is really capturing all of those little details of how you run your numbers and what that economic occupancy is. And you look at other income. Anything that's not rental income is other income. That could be anything from laundry to pet fees to carports or valet trash service programs or anything else. Any other income that is not rental income is considered other income. And then the other thing you want to look at on income statements, and no one ever lists this, is you need to figure out what your reassessed tax value is. A lot of times when you look at, I have literally never seen an OM where a broker said, yep, the taxes today are X, but in the future, you're going to have to pay this if you buy it on the number I'm trying to sell this to you at. And it's a critical number because it will break almost every deal you see. So a lot of times their numbers don't work because they're not factoring that in. All right, so you have to make sure when you're underwriting, you're not using just the T12 numbers for taxes, but you're using the numbers based on what you're going to do to the asset. And then utilities. You want to confirm the utility costs on there, okay? So this is a rough example, okay? And I want you guys to walk with me from left to right. So this is a rough deal that I was looking at. The numbers are actually pretty spot on of how our underwriting looked. But you'll see the first column here is the broker pro forma, okay? So you'll see the gross potential rents. Oh, wait, there's a laser, yes. All right, so you see the gross potential rents here that in the broker's mind was $315,000. You basically see that the net income expenses was $134,000. And then if you look at the T12 here, you'll see those numbers don't add up, right? So this is what the broker is projecting. The T12 said the actual rental income was $297. And then when you shoot down to the net income, that's $283. That's a pretty big difference right here in the net operating income. Now, compare this to my year one projections. Now, you see my year one, I have actually, my potential rents are higher than the brokers as well as higher than the T12. Why is that? Why? Because it's gross potential. I'm factoring in my business plan. My business plan was we're going to renovate the majority of the units. As you see here on the other income, you see that going up from $9,300 to $14,000, okay? And then you'll see the economic vacancy is a huge number, $61,000 loss right there is what we have as our economic vacancy, okay? So my net income is actually less than the net income of the T12 with this deal. And check out my net expenses. Geez, $162,000 compared to $138 from the T12. Why is that? Well, when I went through it, guess what? Seller wasn't paying a property manager. I wasn't going to manage it myself. I got to pay a property manager. I got to put a line on them in there. The property tax is going to shoot up after I buy this thing at a much higher value than what they're paying today. So that number is going to shoot up, okay? The utilities, some of them are okay, some of them are a little bit higher. Part of what we're doing with our business plan, when you look at this number increasing, is we're going to implement a RUB system where basically we're going to start charging a flat fee to the tenants for some of the utilities, in particular the water, okay? So that's why you see that number going up. In theory, this number would go down based on that, but we like to be very conservative when we underwrite, okay? So in here, my number here is 113,000. Now, if I made my offer based solely on this 113,000 NOI, I would never do a deal. And brokers would just laugh at me and run away, right? But it's important to understand how the numbers work or could work. I want you to look at the rest of this, okay? This is stabilized. Part of the reason my year one projections look like this is because we're gonna be doing a lot of renovations, and there's a lot of repositioning on this asset. There were tenants that need to be moved out. There were, things that we needed to change. We need to renovate a lot of the asset. So the number actually, we saw it taking a bit of a dip year one. Again, I think this is overly conservative. This deal did not work for us for a lot of reasons, but you'll see that those were the projections that we had. Now you factor that into my stabilized projections. Once we're done with all of our work here, the numbers here from a rental standpoint are 347, and then you'll see this number here for the economic vacancy dropping all the way to 26,000, which is around 7.6%, okay? Net income shoots up, this number goes up, and then we plan on holding this thing for 5 years, so you can see kind of how the numbers work there. And this is around a 50% expense ratio at 185. The point is not to go deep into the numbers. The point is to understand that every time you look at an OM from a broker, you have to go line by line and understand what the story is, understand your business plan. So again, if I'm going to go in and renovate the units, well, that means someone's not paying rent. So if I have 10 units that I'm renovating, that means 10 people aren't paying me rent. And I need to be prepared when the next person moves out. So how am I factoring all those things in there, right? So sometimes you can be more, optimistic, or you can understand what's happening with the asset. Part of the issue with this deal in particular was the asset needed a lot of work. Now, some of the deals that we've done where you don't have to be as aggressive, these numbers look much better year one because you can go in and you can do it over time. As tenants leave, you can go in and renovate the units. So you're not taking a lot of time and taking 20 units down at a time. You can take it more slowly, right? So that's one of the things you want to understand when you're underwriting is what is the business plan, and then how do you go through that business plan line by line? Risk mitigation. I think one of the most important things here is understanding the areas where your numbers may not be accurate. So let's talk about that. One is understanding the market risk. You heard Neil Bawa talk a lot about all the different markets, where jobs are going, population growth, all of those different things. Well, guess what? That's going to play a role in your numbers. If you assume rents are going to increase every year, you should have some data that supports rents increasing every year. And if you don't, then that's a bad projection that you're making. You want to be in strong markets where population is growing, jobs are growing, and you can realistically expect rents to increase. Now, you don't have to do that. But if you're not going to be in a strong market, then you need to factor in those dynamics. So if people are leaving the city, like people are leaving Chicago, you need to go down to the sub-market level, first of all, and understand what's happening in that neighborhood. Go down to the zip code level and understand that neighborhood, what's happening, and then factor in the dynamics based on that. So if the rents are growing because you're near West Side and there's a lot of growth and you've got Facebook there and all this other development, great. Then you can use the numbers that are based on that. But if you're in an area that's not seeing that kind of growth, you want to be more conservative with your projections, because if the numbers tell you people are leaving, why would you assume you can increase rents? Demand is leaving. So you need to make sure you underwrite based on those dynamics, okay? You want to confirm your figures. Just because you think you can get an extra $200 because the broker said that doesn't mean you can get an extra $200. So you need to confirm it in the marketplace. You want to see it. You want to see comps that are getting $200. What finishes do they have? What materials do they have? What location are they in? How does that compare to your location? Don't just look at a map and use properties that are 2 miles away, because a lot of times, neighborhoods are street by street. And if it's a different school district, you using that as a comp is going to throw you off completely. So you need to really understand what are the characteristics here and what is someone going to be willing to pay. You need to think like a renter, okay? You want to evaluate the loan terms too. Why do I say that? You have a couple different ways of financing these deals. You can get a bridge loan, or you can get agency debt. You can get small loans from regional banks as well. But you want to understand the risk that may be involved there, okay? If you're doing a bridge loan, how much time do you have to renovate the property? What happens if you run out of time? Do you need to refinance? Have you created enough equity to refinance? Those are the things you need to keep in mind. If you have agency debt, you have a longer period to execute your business plan, but maybe you have prepayment penalties. Have you factored in prepayment penalties on your exit? So you need to think through all of those things as well, okay? And then the last thing is stress test the deal. These are projections. None of us can predict the future. So stress test the deal. What happens if your vacancy goes from 5% to 7% to 9%? What happens if rents don't grow as well as you would like them to grow? You know, so you want to be able to look at it and say, hey, if these different factors play out, here's what the property or here's what the returns are going to look like. So you want to understand vacancy in particular, cap rates. I didn't even get into cap rates because I just thought it would be a whole other thing. But with cap rates, you know, if you have what's called a reversion cap or an exit cap rate, what happens if the cap rate is a full point higher, a full point lower, 50 basis points or 0.5% higher or lower? You know, that's going to throw your projections way off. It will make a great deal look phenomenal or make a great deal look terrible. You know, and anyone can just change the exit cap rate and make a deal stronger or weaker. So on those things, you know, the rule of thumb is 10 basis points for every year that you hold the asset. In an economy where the market is tighter, people think that we're close to the end of the cycle, I would say be more conservative than that. Look at maybe doing, you know, 15 basis points for every year you're going to hold it, 20 basis points for every year you're going to hold the asset, just to make sure you guys are being very conservative if you're on your underwriting, if you're going to do a value add play, okay? So with that, I know that there's some things we didn't cover. I want to keep it a little bit high level, but let's open it up for kind of discussions and any Q&A. All of them. All of them, because it's a trajectory, right? What it does is it tells me risk. So if I look at year one, how low that year one was, that told me that, hey, there's a lot of risk in this because I can't deliver an 8% return to my investors based on these year one numbers. So I got to execute my butt off to go out and do this, right? What we really like are assets where we're stabilized, we're basically at or just a little bit above the current operations, and then we have the upside going beyond that based on what we're doing. On that particular deal, one of the reasons we didn't like it was the numbers took a dip. And as I looked more and we thought through logically, because the numbers is one piece of it, it's just a spreadsheet. What I would tell you is, as much as you love your spreadsheets, do not make decisions solely based on a spreadsheet. You got to use logic, you got to use common sense, and you have to go line by line. How likely is this to happen, right? So in that case, yes, I could have absolutely did way better than that, but I couldn't change the taxes, and I couldn't change the property management. Those are two things that I couldn't change based on that deal. So, you know, I look at all of them. I think the first one I'm looking at is the year one operations. That one's not as critical, but I'm looking at the life period of the deal. I'm looking at the IRR. That's my main metric. I'm looking at what can I return to investors. So if I look at that stabilized number and the exit over 5 years, that's kind of if there's one go-to, I'm looking at that. But again, if I can't deliver the cash flow during the whole period, then I have other issues. So I got to make sure I can deliver on that cash flow first. John. That was 44 units. Yep. So it's a great question. He asked, did that deal have on-site management? It would not have been on-site management, but I would have had to take on payroll to basically split a manager with another asset. And that was really the only way we can do it, whereas the current owner, they basically had the guy they bought it from, they just kept him on as the manager. So we didn't think that was an option, so we wanted to bring on professional management, and we basically had 2 line items that we had to put in there, so that jacked those expenses way up. Yeah, yeah, great question. The difference between physical and economic vacancy. So if you look at a rent roll basically is everybody who signed a lease, right, who lives in the asset. That's your physical, that will tell you, I mean, if you have 20 units and there's 17 leases, you have 3 people vacant, right? So you've got a 6% vacancy rate, okay? Now, just because you have those people living in the property does not mean they're paying you. And then also, I have gross, if I go back, I have gross potential rents, okay? So that first line is basically saying, hey, market rents are, let's say, $1,000, okay? Market rents are $1,000. That doesn't mean every single lease is $1,000. Maybe maybe Jimmy's been there for the last 10 years, right? So instead of charging Jimmy $1,000, we charge Jimmy $850, and he's been a great tenant. We don't want to raise his rent, so he charges $850. But the unit itself on market would rent for $1,000. That $150 The way we model ours, I capture that in the economic vacancy, okay? So some people don't. Some people just say, hey, here's all the money I made, so that's my rents. But no, we like to capture the gross potential rents, and then look at the actual collection. And anything that's the difference between what we actually collected and the gross potential, it falls into economic vacancy somewhere. So it can either be loss to lease, which is what I just explained. It could be the physical vacancy. It could be concessions. So anything, I'm doing a 1 month's rent-free promotion or anything like that, those are concessions I'm making to drive more people in there. So that captures anything like that that I have to do. In addition, it might be any staffing. If I have a unit where we're rented to a property manager or anything like that, I capture that. Okay.
And based on this, how do you derive your maximum offer based on this data table?
So yes, great question. We reverse engineer it. So our model is extremely complicated, and it would be way too difficult to try to put on here. But in short, what I do is I take this number here at the bottom, the net operating income, and I factor in the returns that I'm looking for my investors. What I would say to you is that when we're buying to deliver returns for our investors. So that is the key metric first and foremost. So I need to understand what kind of returns can I give to them. Can I give them 8% annual returns? Can I give them a 15% IRR? Can I give them something else? I'm looking at that. So those are the numbers I'm looking at based on what my investors get. So I don't care if net operating income is 200 or 150. I care about what kind of returns can I get and what's my maximum offer based on that. The one number I didn't talk about was the cap rate. The cap rate going in does not matter as much as some people think it does. Where it really matters is on the exit and what you can sell the property for. So that's what you need to understand, and that's why you need to be conservative on your back-end cap rate. We call it reversion cap rate or exit cap rate. You got to be conservative there because we want to make sure you can actually get that number. And that way you'll understand too, if you can't get that number or your NOI is not 185, maybe your NOI is only 160, what does that do to your deal? So that's why you stress test it to make sure you understand, okay, if I only get 165 and the cap rate actually is only 5.7 instead of 5.4, what does that do to the deal? So we want to make sure when we go in and look at a deal, we have our pretty confident projections, but then we have our best case and we kind of have our worst case scenarios as well.
Question, are you investors buy the deals on cash or is there any debt service?
Oh, debt service, yeah. We're typically putting debt on deals anywhere between 70 and 75% LTV.
So the
Loan to
NOI,
value ratio.
so the actual NOI is going to be, lower?
No, NOI does not change based on debt service, okay? Debt service comes after this. So the difference is there's two more lines. You'd have net operating income. Underneath this, you'd have debt service. So that's the money you're paying to the bank. And then under that would be your cash flow. That's the money you actually have to distribute. So this is not your distributions. This is the NOI is what everyone's using to evaluate the deal of the property because everyone buys different. Everyone's going to put a different loan on there. Some people may do bridge, some people may pay cash. So that's going to change no matter what.
John, does your NOI include capital expenditures / replacement reserves?
Yes, so it does include operating. Let me back up. So it includes capital reserves for ongoing. So we do like, I think 250 or 300 at the doors. So we have 10 units, we'll do basically 3,000 in capital reserves there. But what it doesn't include is the money up front. So if I'm going in, I'm gonna put $1 million into this asset, that's not captured in my cash flow. I have that separately. So that's why, again, when you jump to the end here, part of what makes this not easy to read is I'm not factoring in the funds that I need to raise to go into the actual asset or operating capital to oversee it over those first few months of operations.
What kind of assurances do you get to make sure the T12s are accurate? What are your recourse if they're not?
Yeah, so a couple things. I mean, one, we want to definitely make sure that they're as accurate as possible. I would say you go through your account. I don't know what you do, but we basically go through a process where we'll verify all the information. We try to get bank documents as much as possible. And then we kind of go through our process with our attorneys to verify a lot of that information as well. Do you do anything different?
Not really. I think you rely heavily on, quote unquote, the team, the people that are the financial Jews within the team. And quite honestly, there is a lot of trust with a lot of these real big professional property managers. They're using systems. There's a lot of disclosure. It's not like buying small deals where you have a hard time getting numbers. It's pretty common that everybody is going to be using a professional and that the numbers are fairly straightforward.
I would say too, you're building a business case, right? So even if the numbers aren't 100% accurate, because some of these mom and pop people, they won't have 100% accurate numbers, they just won't have it. But you need to understand, as you go to every line item, what can you expect? Because their numbers honestly don't matter that much. It's all about what you're going to do. So if their utility costs were X, that's fine. That doesn't guarantee that your utility costs are going to be the same. So you need to verify your utility costs. That's the more important step to take. But in that case, you should call the gas company. You should call the electric company. You should call the water company. You should go through all those things and verify all the presumptions that you have in your document, because that's what really matters.
And following that same thing, it's just like a pro forma. You expect to find numbers in there that shouldn't be there, that you wouldn't use in your underwriting. In that regard, it's not. And you have to verify using numbers that you think are legitimate, that you're going to underwrite.
Yeah.
John, going back to demographics and employment information, which sources do you use to come up with your model assumptions?
Yeah, so I use a lot of the data points that Neil talked about. So USCensus.gov is kind of the gold standard. What happens is a lot of other folks will take that, city.data or city-data.com. They have that, I believe there's one, datausa.io. They also have information. So you go and you pull it up and just confirm it. I always basically Google. I don't take the property address or at least the zip code, Google it with household income and just different things like that, just to pull up kind of a high-level overview. And then from there, I go to apartments.com and I'm looking at comps. I'm looking at, the immediate properties in the area, and I'm looking to see what are they renting for, what finishes do they have, what are the ranges of rents, some super crazy low or some super crazy high, just to give me a sense of the stability, what is normal for the area, who's the typical renter going to be, and really start to understand the market that way. And then what I also do is I will flip that, and I will go to Zillow, and I'll look at single family homes, because that gives me a little bit of a better sense of the neighborhood and who lives there and what are the average houses sell for. And again, there's different places you can get, but I like going on Zillow as well just because I can also see the finishes and see actual houses versus just the data. Like you go to city-data, it's just numbers, and that's great, but that doesn't tell the full story. But if you can see, oh, there's a lot of flippers in this area. Okay, well, why are people rehabbing? Okay, well, that means that there's a lot of transition. That means that people are investing and moving, maybe a lot of couples moving here, so that might be a good audience for us. So you start to just pick up on different cues of a neighborhood and vibe of what's happening. Omar, we partnered with Omar on Dillon Jacksonville. He did a beautiful video where he talked about leveraging Google to identify these submarkets and doing the layers, which I still haven't figured out how to do. But you can take layers and you can put like the grocery stores and the coffee shops and all these things using Google Maps. So you have a property, you can plop it on there and then start using Google Maps to get a sense of what's in that area. We just did something for a deal we have now, and we talked about all the mall's on the other side of the freeway, right? So we talked about the mall, you pull out, you can see all the grocery stores, you can see all the restaurants. So it gives people a good sense of what that area is like and who's living there, the kind of workforce that you're gonna have there and all those things.
John, you stated that you use 7.5% on the vacancy rate on there. How aggressive or conservative should you be with that?
You should understand the market. Whatever number, like literally the numbers, these numbers are garbage. Don't like ignore these numbers. What you should do is understand the market. Like, so you want to confirm your figures, right? 5%, 10%, you're just guessing. Don't guess. Ask your property manager, hey, what's the vacancy rate for the area? Look at comp properties. You got to figure out what the vacancy rate actually is for the area. And then what you want to do is you want to say, okay, you're going to be conservative. You're going to use a higher vacancy rate in the area. You can use the same vacancy rate, but you should never go lower than what the area's vacancy rate is, even if you have a better property. Because if you're fixing it up in theory, you're going to have a better property than some of the other ones. But you should still use at least the market level vacancy rate. And that's not city, that's sub-market, that really core area.
How do you determine your exit cap rate?
Look at historicals, okay? So a lot of people just add 50 basis points. So you buy it for 7, 7% cap rate, they'll say, okay, we're gonna exit at 7.5%. That's one way to do it. What a better way is to understand what does this area trade for, okay? What has it been historically? And it could even just be the asset type, the asset class, and then make sure you're in that range. And I would certainly make sure it's higher. I would say 50 basis points is kind of the benchmark for what we do that I would recommend. And obviously you can go above that. The more you can go above that, the better. But there are levers to pull. One of the challenges of underwriting is it's an art, it's not a science. And ultimately what you're really trying to do is be conservative. So if you're very conservative in 9 line items, you can be a little optimistic on number 10 or 11, right? But you have to make sure that it's a little optimistic and not aggressive. So in that case, if you want to just do 50 basis points, that's cool. But factor in how else you're going to make sure you're protecting your money. Is it a great area? Is it an easy renovation, meaning that it's just going in and doing cabinets and paint? Or are you going to have to go in there and tear up a bunch of stuff? So you got to factor in the entire business plan. You want to have an accurate picture, because if you're just super conservative on everything, the numbers will never work. So you want to make sure that you're being accurate, but then also stress testing that deal. So again, if you're a little bit off and it doesn't trade for that number, what do? Do you have the ability to ride it out? Or now do you have to sell because you only had a 2-year loan? You got a bridge on those 2 years, and now you have to sell. You got to sell for no matter what. That's when you get screwed. If you have a loan in place where you have a 5 years, 10 years, and year 2 you look at renovating or selling it, or rehabbing, or refinancing or selling it, and you don't like the numbers you're getting, you hold on to the asset and you wait. But if you are forced to sell, that's when all this goes out the window, because now you don't have a loan in place, you don't have any options.
So when you say that you call the utility companies to verify the numbers, do they just tell you, even though you don't live there or you're not the owner?
When you have it under contract, you can tell them, hey, I'm under contract to acquire this. They may ask you to send them like the LOI or something like that, but if you're under contract, you then have, that's part of the due diligence process. So you can now go out and verify all those pieces of information. But you can't just do it if you just saw the deal and you just got the broker's package. You can't just start calling in, hey, tell me what the utilities are acting like. That doesn't work. But once you get under contract, that's when you can confirm all of your numbers.
Since you find out the vacancy rate of the property, but also the area, how do you find out the vacancy rate of the area, the neighborhood?
Property management. That's the easiest thing to do. It's property management. There's other resources too. CoStar. CoStar is a great service. Brandon Stack spoke earlier yesterday. But CoStar, that's what they do. There's other ones too. I think. Who do you use? ALN, Yarding Matrix. There's a fourth one as well. There's a Rent. No. But there are companies that do this. ALN, Yarding Matrix, CoStar. There's a fourth one I can't think of right now. It's like Rentology or something like that. But anyway, they call apartment owners once a month, and they just ask them, hey, what are your rents? Hey, what's your occupancy? And they just hound everybody. They take all that data and they'll put together reports. So whenever you're talking to a broker, you can ask them. Most of the time they'll have it, and most of the time they will send it to you. If they don't, that might be a reason. But you can ask them, hey, can you send me the CoStar report? Can you send me the area report? And it'll not just have that property, but it'll list out comp sales, comp rent, square footage, all of that kind of stuff. So a lot of times people request that from the broker.
So when a landlord seller offers a 1 or 2 month concession on a new tenant, is there really any other reason that they're doing that than to just kind of trick a non-savvy investor to calculate their offer price on the gross rents, rather than kind of someone like you who's actually knowing that, okay, the first month free, so that is lower?
I wouldn't say that they're ever trying to trick an investor. I think, first of all, they don't care about the selling at that point. What they're trying to do is rent their property, and they need to go out there and provide an attractive offer to attract tenants. So, if I can tell you first month's free rent, and that gets you to come sign with me, I'm going to do that, right? So that's what they're trying to do. Now they're reporting, but they're reporting in the documentation. Again, some of them maybe they're trying to be slick, but it's on you to figure out what's really going on. So I think, and everyone kind of knows that. No one it's assumed that you're going to do your own due diligence, and the numbers will tell you. You look at a T12, it's going to tell you the story. That's why you ask for it, because it will tell you what they collected. Now, where you may, where you
So on that
may,
note, do you get leases too during the due diligence in case it's a year and a half?
when you get under contract, you can request all the leases as well. Because then you'll see too, that rent roll may not be accurate with what rents actually are. So they may have a rent roll that totals, $1 million, but you actually start pulling leases and you're like, hey, you got $100,000 missing in this is the actual. So there's a lot of stuff there. The other thing too, we got to be short on time, but you need to pay attention to when the renters and all that rent roll come on. Because if someone knows they're going to sell, what they may do is quickly lease up, and maybe they're not doing background checks, and they don't care. They're filling it up, the numbers look good, sell it to you. You deal with the guy that's been evicted 17 times in the last 20 years. Right? So that's something else you got to pay attention to. If you start seeing a lot of them over the last 3 to 6 months, you need to raise that red flag up and say, hey, wait, what's going on? All right, one last question, I think.
Right here. John, in terms of deal flow, how many offers or how many properties you have to see where you make an offer? And then how many offers that you make actually get accepted?
I mean, the rule of thumb is 130, 10, 1. So you need to see 100 to find 30 that you'll underwrite, to find 10 that you'll submit an LOI or an offer on, to actually do one. Depending on who you talk to, that's gone up to 200, 50, 10, 1, but a lot. There, you need to look at a lot of deals. For what we do, because we have investors, if you're buying for yourself, again, it starts with your return metrics. So if you can find a deal that fits your criteria, move forward. Don't try to do it just because someone else has determined 15% is the number that you need. Do what makes sense for you. All right, I think that's it, right?
But if you brought a chair in here, can you please take it back? Otherwise, I'm going to have John do that.
All right, thank you.